Hi everyone, this is Craig, the options linebacker, and this is the weekend report for Sunday, February 28th. I'm going to start out today's video on the monthly and weekly charts of the S&P 500 or the SPX. Now we've gone sideways really the last few days because I believe that we're kind of in tension between some long-term patterns, whether or not it's going to be heading higher from here or whether we're going to be heading lower from here. So right now there's a lot of confusion, a lot of tug of war going on in the market. So let's look at the two possibilities, whether or not it's going higher or lower from here. Now first of all, let's go over the bearish case. This would be a case where the monthly chart has put in that lower high for now and is pulling back. So when I say bearish case, I'm not necessarily saying that we're going to be heading down to S&P 600 again, but perhaps this is just a monthly pullback lower, which is going to send the daily charts down for the next month or two. Now, if that's going to happen in the monthly charts, we'll know about it first on the weekly charts, because the weekly charts, after a full year of making higher highs and higher lows, will put in a lower high. So this is what this will look like, is that it'll start off with a lower high here, and what this will do is this will drag down the monthly chart. Now we do have some precedents for this pattern. After a year of rallying off the bottom, everybody feels that the market is going to just keep on rallying from right now. So there is a degree of complacency that's out there amongst market participants. So let's go back and see how the market had handled a similar situation. Let's go back to the number one crash of all time, which was in 1929. And the rebound off that came in late 29, 1930. And we'll see a similar pattern that we had the initial pullback here. And this is analogous to our June, July 2009 pullback that we had. And then a strong move up from there. And then here's the same thing as the January pullback. And here's where we are right now. Now notice the relationship of the price to the 50-day moving average in red here. That once it got up to this level, it just couldn't handle it, and that's where the lower high in the weekly chart got printed, and this is where the monthly wave lower starts at this point. So this is right now in very similar position to the spring of 1930 after the initial crash, and you can see that what happened after that is it just went lower for a number of years. Okay, so that's the bearish case, and in a minute I'll show you how we can determine whether or not that's playing out versus the bullish case. So let's flip over to the bullish case right now, and to start out with that, let's look at the monthly chart after the last recession that we just had, which ended up in the spring of 2003. Notice that we had a strong move up off the bottom. 2004 was almost just a bull flag that we can draw in here. So this was just a bull flag which took up most of the year before the election breakout, and then more bull flags along the way in 2005, and then we started to really get moving in 2007. So the big moves are made off the bottom, chop in the middle, and then big moves at the top. The important thing to see here is that on the monthly chart, at no time did we really do a big retracement along the way. It was all more walking in place to consolidate these gains. No big pullbacks along the monthly chart. So the bullish outcome would support this, is that we have just brief pullbacks along the way, and you can see that this is just one of them so far. Looking at the weekly chart for the bullish outcome, again, this is nothing more than just a standard pullback that we saw in January, which is resolving to the upside. So for more detail on that, let's go to the daily chart. And on the daily chart, we can see the pullback was a complex wave-based pullback, which is now taken out the prior swing high. So now the higher high here is above the prior swing high from January. And all we're seeing right now is just potentially a bull flag pullback, which will eventually break out above S&P 1115. Now we've seen almost this exact pattern before about 3 years ago. So this happened in February, March of 2007, where we had a complex pullback here, and then a breakout above that, above the prior swing high, and then about a week of bull flag before this thing really just took off to the upside. So we're in a very similar position right now to that, and if you compare these two, they're very similar. Okay, so those are both the bearish case and the bullish case. Now, how are we going to know which one is which? Well, obviously, It'll be easy to figure that out in the rearview mirror, but how can we anticipate whether or not we should shift to be bearish or bullish? Well, this is where I use the fibs, and what I'm going to do is I'm going to measure the recent rally off of the bottom that started in early February to recently, and we can see that the price is now, as of Thursday, went down and touched the 38.2 retracement. So we can expect to see retracements back to 38.2, 50%, or as deep as 61%. So here's the key that we're going to look for, is as long as the price stays above the blue zone, it can go down into the blue zone, but as long as it stays above that blue zone, especially this layer down here at S&P 1070, so I'll mark this right there, S&P 1070. As long as the price stays above this zone, then it's probably going to be the bullish outcome, especially if it breaks above S&P 1115. That'll be our confirmation that things are working their way higher. However, if the price undercuts S&P 1070, especially on a closing bar, it can dip below that intraday, but on a closing bar, if it closes below 1070, then very likely what we're going to see is at least a revisit of S&P 1044, if not lower. Let's briefly go over position management now. This is the Russell 2000 chart, and I'm talking about March positions. We have a bull put spread down here, 51.53 on the IWM, and we have a bear call spread at 66.68 on the IWM as well. Actually, right now, my Greeks are showing that I have very, very little risk of a 1-point move of the IWM in either direction right now. So I'm almost totally delta neutral on this position. This is because we thinned out this position earlier this week, so we have very little risk on the upside, as well as the fact that we have an upside hedge for this. Now, we know exactly where we'll take off the upside hedge if we don't need it anymore, in case the price comes down to here, in which case we would win these positions. And we have a long distance to get down to the lower bull put spreads with a nice butterfly in the way to act as kind of a moat around our castle for defense. So this position is looking very good, and we know exactly what we'll do, whether or not the price will go up or down from here. And for March, we also have bull put spreads on the spiders down here at the 94 strike of the spiders with a butterfly in the way, so that's looking great. And we've also started our back month offense for April. On Thursday's dip down to the 38.2% retracement, we got ahead and split up the order into a couple of bull put spreads with the short strikes at 97 and 98 on the spiders. And we're looking for our call spreads on any kind of bounce up later on this week, and those are going to be up near the 1200 area on the S&P. Thanks for watching, everybody. Have a great weekend.